The IMF deals have sparked hot and crucial debates on various platforms among youths and politicians in Zambia and across the continent of Africa. We must be reminded that the IMF was created in the wake of World War II to manage the global regime of exchange rates and international payments. Since the collapse of fixed exchange rates in 1973, the fund has taken a more active role, intervening in debt crises in developing countries and responding to the pandemic-induced economic crisis. But we must understand that the conditions the fund attaches to its loans are too harsh and have harmed developing countries. Since its inception in July 1944, the International Monetary Fund has undergone considerable change. As chief steward of the world's monetary system, officially charged with managing the global regime of exchange rates and international payments that allows nations to do business with one another. Sounds good, right? But the fund has received both criticism and credit for its efforts to promote financial stability. Some economists claim that it's in the midst of a major transformation, citing its vast expansion of lending capacity, governance reforms, and the move away from the free market fundamentalism. Unlike the World Bank, which was designed as a lending institution focused on longer-term development and social projects, the IMF was born as a watchdog of the monetary and exchange rate policies vital to global markets. The fund permits its membership access to a common pool of resources, funds that represent the financial commitment or quota contributed by each nation relative to its size. In theory, members with balance of payment trouble seek recourse with the fund to buy time to rectify their economic policies and restore economic growth. But how does the fund pursue its mission? The fund pursues its mission in three fundamental ways. The first one, a formal system of review monitors the financial and economic policies of member countries and offers macroeconomic and financial policy advice. Second, that's technical assistance. The fund offers support and training directed mainly at low and middle income countries, help manage their economies. And the third way is lending. The fund gives loans to member countries that are struggling to meet their international obligations. Loans or bailouts are provided in return for implementing specific IMF conditions designed to put government finances on a sustainable footing and restore growth, known as structural adjustment. These policies have included balancing the budget, removing state subsidies, privatizing state enterprises, liberalizing trade and currency policy, and removing barriers to foreign investment and capital flows. The IMF has been called the world's financial crisis firefighter, relied on by member countries to deal with sovereign debt and prevent contagion from spreading through the global financial system. A member country typically summons the fund when it cannot or no longer finance imports or service its debts to creditors, a sign of potential crisis. The fund will extend the government a loan and help organize a new debt repayment plan. that the country can manage. In exchange, the member agrees to implement IMF reforms designed to rectify its balance of payment and restore foreign exchange reserves in its central bank. The lending conditions are designed not only to guarantee the repayment of loans, but also to ensure the money borrowed will be spent in line with the stated economic objectives. The IMF cannot force its will on member countries. Countries accept the fund's conditioned financial assistance on voluntary basis. Very important. The country willingly signs those documents. On the other hand, the fund has drawn criticism over the years. The fund has been seen as a primary culprit in the failed development policies implemented in some of the world's poorest countries. Many of the economic reforms the IMF require as conditions for its lending, such as fiscal austerity, high interest rates, trade liberalization, privatization, and open capital markets, have often been counterproductive for target economies and devastating for local population. All that glitters is not gold. Open your eyes, Africa, and take care.